Yo, what's going on, you guys? It's Sherry Trades back in one other banger video. Hope all of you guys are having a fucking wonderful day. I did want to go ahead and come back today, bro. This is the first trading recap I've done in a while. It's a Friday at 10:12 p.m. right here. It's been a day for me to kind of catch up on my rest and get back to the grind of YouTube, right? So I want to connect back with you guys, and I hope all you guys are having a wonderful day. Hopefully God has blessed you. Everything's been good. But guys, I had a fucking insane week. This week I did lose $5,500, and in one day, one trading day, I lost 5,500 trading an extremely high risk play. Man, all the signs were there, but you know what? I was stubborn. I was, sticking to my thesis that as a bull, and I went against the trend, and I did end up paying the consequences. So today, instead of sitting around crying about it, I always tell you guys, I'm always gonna be more open and showing you guys my losses than my wins, because in the losses, it's where you learn. You learn through losing, and you win. And when you win, you reap the benefit of, your lessons that you've learned during your losses. So, unfortunately, this is a very sad story, but the best thing I can do out of it is share it with you guys so you guys don't make the same mistakes as me. And you know what? May my losses be your win educationally and learning wise. So let's go ahead and jump right into it, man. I know I haven't done one of these market recaps in a while, so I did want to do this one a little bit more of a new style. Let me go ahead and fix the screen here. So I did go ahead and annotate it. I did go ahead and make it a little bit more presentable for you guys to understand everything. So this is the position, right? First things first. We had a big narrative in the market. What is a narrative, right? A narrative in the market is when investors begin to feel different about buying and they're switching to more of a selling approach. So they start selling assets and the market begins to trend downwards, as which we've seen this week. We reached this high over here on Wednesday. And after war in Iran and Israel, you guys got to be conscious of all this stuff. What's happening around the world? How is it impacting the markets? Well, as that war began to get more and more serious, we began to trend downwards. So I went ahead and, was like, okay, let's look at the key levels, right? Let's look at where we're at. Starting on Tuesday, right? We had this super huge low. Let me go to the bigger picture here. Monday, right? Starting the week, we had a high up here that has held up at 687. Looks like we haven't been able to break out of that. We had a pretty consistent low over here at 670 that was initially support. To my knowledge, 673, I thought it was 676. 676 down here was that key level support that we've been holding all fucking month long. Looky here. 676.21, 676, 676, 676, 676. Back until December, even maybe late November, you see that we hit this level. Let me bring it over here. Late November, right here, we hit, come up. Mid-December, hit, come up. Over here, January, hit, come up. Again in February, hit, came up. Again, February 17, hit, came up. Broke a little bit lower on March 3rd, and then eventually came up. Contacted that level once again at 676 here on Thursday and came up. So what do we call this level? Well, we call that level a support level. Well, Jerry, what does a support mean? I've never traded before. I don't know what none of this means. Well, a support level is where typically how I explain it to my clients, it's around where 80% of buyers, or you can arguably say maybe 70% of buyers are sitting at. So I give my clients recently, I came up with this example. If an iPhone used to cost $1,000 up here. Oh, wrong one. If an iPhone used to cost $1,000 up here, right? And when you buy your iPhone, no, let's say you didn't buy an iPhone, and you're like, damn, I've always wanted one. But when the iPhone later on, let's say they mass produce them, and it drops to here, and now they're worth 50 bucks, or maybe let's say 500 bucks. All right, now it's half off. So a lot of people are going to come in and buy this phone, right? They want it. Hey, 50% off of a $1,000 phone? Hell yeah, I'm going to come and buy it. But even then, there's still might be people that don't buy it because it's still too much. So that's what we call that support zone. Sorry, I've been getting sick, you guys, trying to get better out here. But this support zone is where a lot of people are going to come in and buy, but not all of them. Now, the next level that we really look for is this supply zone. So this supply zone, as you can see, 670, 670, around here 671, 671, right around that range of 671.50 to 670 flat. We no sellers, everyone will put their houses down, everyone will buy at this price range. So that's essentially how you use the iPhone perspective now. So to make it simple for you guys, iPhones were going for $1,000 up here at the top right here, or right here at the top. Now they dropped here to a support level. They're going for $500. Some people are going to come by, but there still might be some people on the side waiting. Over here at the bottom, now iPhones are now going for $50. 670, this range all the way across here. You're going to see it if I stretch it all the way out. 670, 670. I'm actually going to jump on a bigger time frame to make this more effective. So at 670 in the recent times, right, back until December 19th, you see that arguably there's no one not buying here at this range of 671.50 down to 670. $50 iPhones, everyone's coming in and buying them like hotcakes. Here's my $50, here's my $50. This is what we call a supply zone. Supply zone, no argument. Put your house on it because it's going to come up. Assuming the world's not ending, the United States didn't just drop a nuke on Iran. I don't know, Donald Trump didn't just get assassinated. Any crazy economic or political event like that could possibly break below a supply. But for the most part, if there's some sort of economic stability and things aren't that serious, it's going to jump back up off of these supply zones. So what happened to me on Thursday? Why did I lose so much money, Jerry? Well, let's jump into it. Now that you guys understand these key levels and you know how we played out on the bigger time frame, well, as we approach what we call a day trade, remember a day trade under time. So that's the full span of one trading day. And when you're trading contracts in a 0-day expiration, which is also another term of maybe referring a day trade, when you're trading these contracts lose value very quickly. So how I always explain this to my clients, it's like essentially, let me see if I can bring this up. Essentially, I drew this illustration here to help you guys understand it. So my position value was around $5,000. It was in total 5.5, but it didn't start like that. It started with just maybe like $300 here. 6 cons times $54. Let me go ahead and do the math real quick. 6 times 54. You buy contracts, right? So 6 times 54 was $325 here, and then I added 25 times 54 right here, so that's $1,350 plus another $324, that's $1,674, and then I added another 2 for 41, so that's gonna bring me up to 82 plus 82, and then I added another 20 for 43, which 20 is going to be 26.16. So by this level here at 9:26 a.m., I already had a position value of 2,600. And I realistically looking back at it, I wish I would have cut it then. I wish I would have just left that much in capital and not put any more. But I'm young, we make mistakes, I'm an aggressive investor, I don't like losing. If I have capital in the bank, I know how to navigate dollar cost averaging to try to get me out, assuming the market conditions are in my favor. And in this specific scenario, guys, I actually got absolutely obliterated. So back to the illustration here. So how I like to explain contract value versus a day trade, or what we call time decay. Because you have to understand, when you're trading stock options, the contract that you own, which is the asset, as it approaches what we call an expiration date, which is the final day or the final moment you have to either sell this asset for a profit or a loss, it's losing value. So how to make it simplified for just an average Joe to understand, it's like, let's say hypothetically right here, I bought a car for 0 miles, top of the line, boom. If I try to sell it right here, I'm going to get the most bang for my buck. I might get all of my money back, right? Now, if I go ahead and use the car and by here, which is, just to keep it in times where maybe like 7 a.m., now I put 40,000 miles on the car, the guy that's going to buy the car off of me isn't going to pay me what I got it for. And then over here, if by maybe 9 a.m., now I have maybe 100,000 miles on the car, the guy isn't going to pay me. The buyer of the car is not going to pay me what I got it for over here. Why? Because I've used it. There's there's wear and tear on it, there's usage, and really quite significant usage. And as we approach now 11 a.m., this car now has maybe 150,000 miles. The buyer on that car is not going to want to pay me what I bought it for. They're going to want to lowball me. It's going to be a lot less than what I paid for. And then if I go and push it further to 12:30, right before market close with 30 minutes left, I try to sell this car. It has a check engine light. The motor's making noises. The exhaust is throwing fumes. No one's going to want to buy this car. Maybe they'll give me 20 bucks for it. That's how I kind of explain contract value and, more importantly, theta. Theta is one of the Greeks in option trading that impact time decay. So it impacts contract value as it approaches an expiration date. It's important you guys get familiar with this term, especially if you're looking to start trading shorter time frame option contracts with a shorter expiration date, usually going to be your 0-day expirations, or you could get familiar with it in intraday. I think something like a swing trade and a leap trade, it is a lot less aggressive, but when you're trading 0 DTEs and intradays, theta is a Greek that, or a factor of your contracts that you want to pay attention to. So in this case, these contracts are rapidly losing value. Right here, I bought 6 for 54. I went in the green. I was plus $300 right here, but I was greedy. I put in 324 and I made back 324. Immediately, 120% return. I should have sold. But, you know, in my head, I'm like, all right, look. Yesterday, we were at these same levels here. Remember these key levels, right? This is the demand and this is the big supply, but when you're shifting from, I guess, these highs and lows and you're setting up new data sets in between every day, you always want to take new key levels. So in this scenario, as you guys can see, market opened up here at the high, but this is already an outlier of data. We didn't build up no sideways movement here for me to use as a true kind of point of reference. We didn't do this up here. There was none of this for me to say, hey, this is my key levels that I'm going to use. Instead, we just dropped down, you know, we kept ripping. So now I'm going to use all of this data that's here as my data set. So to kind of clear all this up, that's an outlier of data. So I'm not going to use that. So then I started noticing, okay, we hit a bottom right here and we hit a top right here. This then becomes my demand. So I'm going to go ahead, let go of the illustration. Text demand, oh shit, demand up here, bottom being my supply, because that's the low, right? The lowest it's ever went. So we got already our supply and we got our demand. I haven't seen resistance or support just yet. Once it dropped down and confirmed that at 8:11 a.m. that this was gonna be our supply, remember where that iPhone is for fucking 50 bucks, where people aren't arguing if they're gonna buy it or not, that's supply. So look at it. Hit, came up, hit, came up. In my eyes, I'm like, great, we found the bottom, I'm gonna enter. I waited for a hit to break above what we now know as support. What is support and how did I know it happened? Support, I knew I had found support by 8:36 a.m. Why? Because at 8:36 a.m., look at what happens here. Hits. Let me zoom in more so you guys can really see this, because I know like on your guys' perception it might look a little bit different. So now you really see it. So we hit this line, look at this wick. We hit, jump up. Hit right here, jump up. That became my support line. It kind of already showed itself over here as well on this first break off of supply. Hit and jumped up instead of breaking down. So that's my support. Now my next job is to find resistance. Well, resistance, let me go ahead and click on this. Go ahead and title it support. Up here at the top, you have resistance. So resistance is where like you're trying to push on up and it just pushes you down. So we went up, broke above support. Look at what happened here. Let me go ahead and bring it up closer because I know that green might be messing with you guys. So look at hit, came down, hit, came down. Hit, broke it a little bit. Remember, demand. Imagine you're the guy that bought an iPhone for $50 now. You know, demand is always going to be that spot. Hey, you bought an iPhone for $50. Hypothetically, Apple stops making them. Apple starts selling them. Now these things just became as rare as a fucking Bitcoin. Now they're worth $10,000. At this level of demand, everyone's going to sell their iPhone. No one's going to hold on to it no matter how cheap they got it for. They just want the cash. It's worth it. I'm gone. So at demand, look at what happens. Sells off. And then once again, we kind of catch a little bit of some buys here around support and push back up towards resistance. So now you're learning, you're seeing that, oh shit, these levels are real and they're very important for me to use as a trader if I'm trying to get serious. And you got to learn how to find them. So long story short, once you went ahead and established your resistance and your support, look it, broke below and we hit supply again. So this whole time I'm thinking, all right, this is our range. I'm here. I started at 6 cons at $54 each, went ahead and went all the way to a take profit up here at the top. And then I was up $300. We had dropped down here to this support level, and I'm like, you know what? I'm gonna add some more. Because remember, I entered from here and we hit resistance, so I was already in the green a lot. I was up 100%. Now from here it dropped down. I'm like, well, fuck, I don't want to lose anymore. I want to make more. And I seen how aggressive. Look at the trend. A trend is how the direction of the market is going. So the big trend of the market is right here. Look at this. Let me go ahead and just remove this and remove this. The trend of the market at market open is bearish. It is going downward. Bearish means down, all right? For those of you guys that don't know. So bearish means downward. Now, look at the jump when it breaks this trend. Look at these lines. You see this break of trend right here? When we broke out of these downward lines and now we're pushing up. That's what we call a break of structure. So that's when it means it starts pushing back up and now we have a new trend, which in this case was bullish. That's why I have this line right here that I illustrated for you guys to see the bullish momentum. So I'm like, all right, cool. This is our range. Maybe we're going to go from supply here at 679 to a high of 685. So I'm like, hell yeah, like I'm going to load up on my contracts because I'm about to make $18,000 if we go back up to 685. So I'm like, cool, I'm going to go ahead and bet my money. Like I'm okay with risking, you know what, at this time, 6.5, 6 times 54 and 25 times 53. I think that was like a total of, like I told you guys, I wish I would have kept it at this calculation, which was 2616. So I had $2,616, and if it would have went up to 685, bro, I would have walked away with probably like $7,000-8,000 in profit in one morning. Look at 9:21 a.m. is the timestamp that's down here, by the way. So 9:21 a.m. market opens at 6:30. In 3 hours, I would have made $7,000, a shitload of money. So it was, to me, in my eyes, okay taking the risk. But then everything fucking turned on its head. We hit here at 682, and by here I was already up, you know, $300. I was doing really good. I was phenomenal. I liked my return. After that, I went ahead and seen the market start to push fucking down. And I'm like, fuck, like I should have took profits. I'm mad. I'm getting more emotional now. And as a trader, as you begin to develop your experience level, you too will find that you'll get emotionally invested. You'll get maybe a little bit frustrated, and then you react differently. Everyone has different results. And this is when I ran into dollar cost averaging versus stop loss. I wish in this trade I would have stuck to my stop loss. Because why? Once we started breaking down below, look at where my entries are at. They're all right here. They're all right here. But remember, contract value declines as we approach 1 p.m. So despite me buying them here at these levels, we're approaching now 9:15 a.m., which is somewhere around here in the middle. So instead of making, you know, that 1,500 profit if I would have got it right instantly, now since we're approaching the day and value's going down, remember the car example, the car now has, instead of 0 miles, the car has maybe 50,000 miles. No one's going to buy that car off of me for what I paid for it at 0. They're going to want it cheaper. So now my contracts, despite being at this good entry, are now worth less because of the time, the usage, the decay. So I'm like, fuck, what do I do? And I'm like, all right, well, we're at support. At support, I add 22 contracts. I buy 20 for 0.48. That's 800 and I think what, $6? And then another 2, so that's what, $482. So 880, I don't know, fucking 6 plus 2, that's 8. So $888 to add right here. Then I see like, fuck, support didn't hold up. We're not going to go from support to demand. All right, at supply, remember, this is the spot where at supply, everyone's gonna buy an iPhone. If iPhones used to go for $1,000 right here at demand, and now they drop to a level of $50, usually at supply, everyone's going to come in and buy them. They're going to swoop them up because it's a steal. And like I told you guys, we had hit this level and bounced up, hit this level and bounced up. Sure, it wasn't the 676 that we had historically to prove back in the past, as you guys can see on these bigger time frames. 676 came up, this is 671. 676 came up, 676 right here came up. Let me go ahead and bring, I wish I could, let me move the screen so you guys can actually see that. 676 right here, look at the right. I'm going to zoom it in a little bit, maybe that might help. I don't know, it looks a little bit like less legible, I'm sorry about that. But this is 676. 676 hits, comes up, 676 comes up, 676 comes up. So you know at 676, hey, that's technically like the $50 iPhone, the real deal one. But remember, as you're trading 0-day contracts, you always want to adapt to the data that you have in the day. So as I'm looking right here at 676, I'm like, fuck, bro. Like, I know this is the real bottom now, but now all of my contracts, which is my $2,300 right here, is probably negative 70% because of one, the time decay, and now how far out the money I am, which is the second variable that kind of destroyed me. In these contracts, there's your expiration date that increases risk. Like I said, my expiration date was a 0-day expiration, meaning that I only had from 6:30 a.m. to 1 p.m. to make money. It didn't happen. It's alright, it happens. But if I would have had a closer strike price, I would have made more money. Let me go ahead and explain this to you. We're now here at 679, 676. My strike price where I needed to hit to make my, I guess like my contracts be worth something was right here at 683. So I needed to get here. This was my target range, 683. But look at how far down we are now. And I'm getting cooked, 2600 in the drain right here, bro. And then I get aggressive. And that's when I'm like, all right, you know what? We're here at 676. We bounced up. Hey, I'm right here buying below our initial supply, right? Remember, supply was right here because it was the lowest. Came up, $50 iPhone example, came up. Down here at the bottom at 676, technically now established itself as a new supply. And this one has burnt out and kind of became a support. You have to constantly be adapting to them. So I'm like, all right, at this supply zone here, I'm going to go ahead and add more because we have to come back up. But look at this right here. It started at 9:50 a.m. It's going to be hard to read on the screen, I'm sorry. But 9:50 a.m. we started right here. And then look, we always stuck to this range. We would hit this high, come down, hit this high, come down, hit this high, come down, hit this high, come down. And then we'll hit the supply and come up, hit the supply and come up, hit the supply and come up, hit the supply and come up. All right, that's cool, you know, if I was fucking trading right there, but guess what? I have fucking $2,600 right here. And time is just burning. If time is burning, remember the car example. This is 60,000 miles, 100,000 miles, 120,000 miles. No one's going to pay me what I bought the car for right here. Oh my God, right here, look. This is 50,000 miles. This is 100,000 miles. This is 150,000 miles. No one's going to pay me what I bought the car for right here. So over here, guess what? We're looking at 150,000 miles. No one's going to want to buy my junk that I paid for all the way up here. Not for what I got it for, so I'm losing money. So I had to do something about it. Well, my reaction to what I was going to do about it was to buy more on this and take advantage of this jump up. But remember, look at the jump up and when it happened. It happened at 1206. Happened at 1206 from 676, but look at my target range is up here at 683. Let me slim it down so you guys see how unachievable it was. 683, bro. I have to shoot for holy crap. Excuse me, you guys. I have to shoot for the damn stars right now to hopefully get my money back. And yeah, this move did jump up and push contracts slightly above. Because look, I bought some right here for 60 contracts right here at this level. Let me zoom it in real quick. Once we hit supply and we started breaking above, I'm like, you know what? Maybe this is going to start the trend. This is going to start our push from supply and go back to demand or at least resistance, and I could get the fuck out for my money back, or maybe just take, I don't know, a $700 loss. Anything but minus 3,000 at this point. But guess what? We fucking shit ourselves. We went down. Look at this. Look at this drop off of demand right here. Demand hit, dropped again to supply. And then look at what it did. It consolidated. Consolidated means sideways. There's no trend. There's no going up. There's no going down. It just looks sideways. It looks like this. Flat and flat. Yeah, it goes up and down, but there's no trend. So that consolidation, when you're trading these type of contracts, it's burning time. It's putting more miles on your car, making them worth less. So I'm losing a shitload of fucking value right here. And I'm in my chair contemplating just taking the loss, or what the fuck do I do? And I kind of resort to my last mission. I buy 150 of them for $13, bro. Let me do the math real quick, because I don't know, I'm fucking kind of mad. Times 13 bucks. Bro, I paid $2,000 right here at the bottom as my last fucking final draw. Like, this is it. It has to come up. I paid it. We jumped up, but guess what? Since we're this far in the day, now at 10:46 a.m., and remember, my target being so up here, the fact that my strike price was so high, it decreased the probability of my contracts hitting that. So there's a Greek called delta. Delta literally tells you the probability of these contracts making money. My delta went from up here at a maybe like 16% or 30% to now here at the bottom, motherfucker, a 2% chance it goes up and makes some money. So as a buyer, right, someone else as an investor that's going to buy my contracts, he's looking at these contracts and he has to buy them with the okay of a 2% chance of winning. Are you going to buy something for $2,000 knowing that you have a 2% chance of winning? Probably not. And that's how investors felt about my contracts. So price was significantly dropping, and despite this big jump up, despite these pushes up, since my strike price, more importantly, was so far out the money, no matter if it pushed up, people still didn't value it because they didn't think that before market close we'd actually get 683. So right here I ended up closing my contracts here at the bottom right here for 0.02 contracts. So I sold 277 contracts total for 0.02, and I walked away with a total of, I think it was like 277 times $2. Yeah, I walked away with $544 when initially I had, fuck, bro, let me tell you guys right here. I'll show you guys, bro. At the end of the day, this is documenting my journey as a 23-year-old option trader. I'm going to look back at this shit and trip one day. And it's a story I'm going to tell my kids. It is what it is. I lost. I hope the camera picks it up right there. Let's bring the camera up a little bit bigger so you guys can see this, because this is fucking mind-blowing, bro. Right here, bro. Can you guys see that? Is that helpful? The glare a little bit? Come on, baby. Do your thing. Focus on that. That's fucking janky, homie. I don't know if it's maybe the screen glare. Maybe that will help. That's honestly some bullshit, bro. Let's just focus on that real quick. That's some bullshit. But long story short, I lost $5,536 selling right here for 0.2. Selling 277 contracts for $2. Craziest loss of my fucking journey, or not my journey, because I've lost more. I have another trade with Apple where I lost, or more so Intuit, I lost $17,000 in one day. That one was fucking gnarly. I never got to document it because I was never into YouTube and all this other crazy shit with SoCal Trading Group by then. But this one scarred me for life. Fucking first trading week of February, or last trading week of February actually, or no, actually first trading week of March. Absolutely fucking obliterated, homie. This one was horrible. But there's lessons to this. There's for sure lessons to follow and learn from. So Jerry, how the fuck could you have not lost $5,000? Well, one thing when you're playing with money, and it's a lot of money, right? It's valuable. $2,000, like, no one wants to see that shit. No one wants to feel that, especially in a day. So I'm minus 2,000, bro. Once I seen this break, remember, this used to be our supply before it dropped, and this used to be support up here. Once I seen supply break, I should have, being an experienced trader, supposedly, like mature, the mentor, the guy everyone looks up to, I should have been a little bit more responsible and cut my losses at supply. I would have got out, hey, maybe minus 2,600 or maybe minus 1,800. I don't know exactly what the amount would have been right here, but I would have lost 1,800. Compare that to 5.5K. In the moment, 1,800 feels like hell. It feels like, fuck, it hurts. But imagine the bloodbath that I didn't know was awaiting for me. I would have much rather lost 1.8K than fucking 5.5 thousand. And that's the lesson to learn. Stick to the stop loss instead of going to war with the dollar cost average. Because what I was doing here, when buying more contracts, you guys have to understand, it's called dollar cost averaging. So dollar cost averaging, it's like you buy one contract for $100, and then they fucking drop to $20. If you buy like 4 contracts at $20 and you have one at 100, that cost of 100 now it's gonna get averaged down maybe like to like $30. So now when you're here at the bottom, you don't need to go back to 100 to start making money. Once you go above $30, you're already making money because you bought 5 for 20, bringing your cost lower, making your profits higher now since your cost is cheaper. So you don't need to wait for $100 to make money. No, you bought 5 at the bottom, now you can make money from 30 because you bought 5 for 20. That's dollar cost averaging, and it's a way that could potentially save your positions if you're down in the dump. It's a way that could potentially make you more profits if you bought one contract for an extremely high amount. And that's usually how I trade. I'm a dollar cost averaging guy instead of a stop loss guy. More importantly, why? Because I have a cash account. If I had a margin account, for those of you guys that don't know what those are, a margin account is an account where you have credit. Robinhood, whatever brokerage you have, they see you made money. Okay, cool. We give you a $25,000 credit. It doesn't mean if you lose $25,000, you have to pay them back. No, you play with your own money, but when you make profits, they see that and they pay you your money out instantly because you made profits. Meaning that if I close the trade right now and I made $2,000, they're gonna pay me my $2,000 then and there. I don't have to wait till the next day because I have a credit with them. If I lose $2,000, I only lose 2,000. I don't owe them nothing. But if I make money, I have that credit. So that gets paid out to you instantly. And then you could go take a trade, another trade. You could go either on the way up and you cash out right here. And then you're like, fuck, I want to bet on the way down or take a trade on the way down. You can because you got your money back. And you could trade on the way down. But when you're dealing with a capital or a portfolio with less than $25,000, you can't necessarily get your money. You can't necessarily day trade. They limit you. You can only take 3 day trades in a span of 4 days. So I've been trading for 5 years. I blew that a long time ago. I did more than 4 trades multiple times, twice to be more specific. So I took 6 trades in less than 8 days throughout my career, and I lost that ability to access a margin account. So now if I want to trade and get my money back, I need a portfolio value of 25,000 to get my money back instantly and then start trading again every single day or every moment, like taking the way up and taking the way down. So since I'm on a cash account, well, what's the negative, Jerry? Why is this such a problem? On a cash account, once you put money in and you sell, you got the profits, but they're not giving it to you instantly. They have to process it. They got to take, the credit, and then the next day you get your money back. You get your profit and your money back, but it takes a whole day. So since I don't have that ability to jump in and out of trades and I have to wait till the next day, I make my trades count, or I make my capital count to make me money, because I know there's no using this money to get back in on some shit coming down or some shit coming up. I have to make them count. And that's why I became more of a dollar cost averaging kind of trader rather than a stop loss kind of trader. And it's been impacting me for the last maybe 6 months, not having that ability to get my money then and there instantly. And it fucked me up. But damn, can't do much. Complaining doesn't get shit done, doesn't make you feel any better, but you have to adapt. And I tried to adapt in this trade using dollar cost averaging completely got fucking smoked. One of the worst trades of my career starting 2026. But hey, may my losses be your win, and hopefully you guys learned something here today. Insane fucking trade, absolutely horrible. It is what it is, boys. It's gonna, markets don't wait for no one. It's gonna open right back up on Monday, and if I'm there making money or not, they're not waiting for me. So my job is to keep on going, share my losses with you guys, share my wins with you guys to give you guys a better chance at finding success in this trading journey. And may my loss be your guys' win. That's my SPY 03 March 6, 2026 minus 5.5 thousand in one day trading recap. Jerry Trades of SoCal Trading Group over.